Hello everyone, this is your quiz review video for your Chapter 5 quiz on the Perpetual inventory system. A quick reminder, whenever we make sales or even purchases on account, there are going to be credit terms most likely attached to that purchase. The example we have here is 210 net 60. That's our credit terms, and what it means is you get 2% off if you pay within 10 days and the full balance is due in 60 days. We have two options for how we record our sales and our purchases. We can record them either via the net method or the gross method. In the net method, we are going to assume that all discount periods are going to be met at the time the transaction is recorded. What that means is when we make a sale, we assume that our customers are going to pay us as fast as they can in order to get that discount that we were offering in the credit terms. So when we record our revenues from sales, we're going to record them not at the full amount we could get if they forfeited their discount, but instead at that discounted amount. We assume they're going to get 2% off or 3% off or whatever. When we make a purchase, we're going to assume that we are going to pay promptly enough to get the discount. So when we put the payable on our books and when we put the inventory that we're buying on our books, we are going to put it on for an amount equal to the discounted amount. We're assuming we're going to get 2% off, 3% off, etc. The other option is to record gross. And under this, we assume that all discount periods are never going to be met. So if we make a sale, we're going to assume that our customers are going to miss the discount period and pay us the full amount that they possibly could. And when we make a purchase, we would assume that we're going to miss the discount period and we're going to have to pay as much as possible to acquire that inventory. How do you determine which one to use? Well, it's based on the historical precedent of your company. If your customers typically make the discount period and you typically make the discount period when you pay the vendors that you bought the inventory from originally, you record net. You assume that all discounts are going to be met because that's what most commonly happens to you. Vice versa, if your customers typically don't pay within the discount period, you should record the revenues at the maximum amount they could possibly pay you, because that's what typically happens. They miss their discount period and they give you as much money as you billed them for originally. When you make a purchase and you assume that you're not going to get the discount period, well, you put the payable in that inventory on your books at the full amount that you could possibly pay, again assuming you're not going to get the discount because that's your normal course of operations. You don't typically pay during the discount period. What if you don't know what to do? Well, you should abide by this thing called the gap conservatism principle. And what the gap conservatism principle is a big, long, fancy definition. But the simplest way to put it is, when in doubt, we should record transactions in the least favorable way for our company. What's the least favorable thing that could happen to our company? The least favorable thing that could happen is that our customers always make their discount period, therefore sending us as little money as possible, and that we always miss our discount period and have to pay as much as we possibly could for the inventory that we're purchasing. So to abide by this conservatism principle, we should assume that customers are always going to get their discount and therefore record all sales using that net method. And we should assume that we'll never receive a discount on any of our purchases, assuming that all of our purchases are paid at the full amount without a discount. We're going to record them using the gross method. Here we have the journal entry for the purchase of inventory. On July 1st, Halo Hats is going to purchase 2,000 baseball caps from a company called Harriet Wholesalers. These hats are going to cost $6,000, and Harriet Wholesalers is going to give Halo Hats credit terms of $215 net 30. So Halo Hats gets 2% off. They pay within 15 days. The full balance is due in 30 days. We're Halo Hats. We're going to put this purchase on our books. So on July 1st, we are going to debit merchandise inventory, increasing the amount of inventory we have because we just purchased it, asset account going up, so it's debited, and we're going to do so for the full $6,000. Why? Because to be conservative, we're assuming that we're going to miss that 15-day discount period. The credit should be to the payable. We owe Harriet Wholesalers money. The account we're going to use here is called the subsidiary account. Accounts payable tracks all of the money you owe to everybody, but you can break it down into the different people you owe money to. Those are called sub-accounts. We're going to make our own separate payable account for Harriet Wholesalers called AP-Harriet Wholesalers. It is still a liability account, and like all liability liability accounts, it still goes up with a credit. So we're going to assume that we're missing that 2% discount, and we're going to eventually have to pay Harriet Wholesalers that $6,000 in full, and we credit AP Harriet Wholesalers for that $6,000. We purchased inventory on account, terms of $215 net 30. On July 3rd, Halo Hats is going to pay a $100 freight charge in cash when the caps arrive from Harriet Wholesalers. It's kind of a strange entry. What's happening here is some third party, somebody, is bringing these hats to us, and at the time that these hats arrive, we have to make a cash payment to that delivery service for the delivery of those hats. The cost of that is going to go into merchandise inventory. Why? Because merchandise inventory tracks the amount that we paid to get merchandise to our store, on our shelves, or in our warehouse in a sellable condition. Well, delivery is definitely part of that. So instead of recording this as some kind of expense, we're actually going to put this extra $100 into our merchandise inventory asset account. And our credit is how we paid for this freight charge, and that is cash for $100. We paid a freight charge for inventory delivery. Next up, we have July 4th. And on July 4th, Halo Hats is going to return $500 worth of the baseball caps that we purchased on July 1st. These caps were damaged. They are in unsellable condition. We have no need for them. We can't sell them. So we contacted our vendor and we told them, hey, these caps came messed up. We're going to send them back to you. They said, okay. We send them back. And when we send them back, we're not going to owe them the money for it anymore. So we can't continue to have our payable on the books at that full amount because we're not going to pay for these damaged hats that we got. So we're going to reduce our payable to Harriet Wholesalers by the cost of those damaged caps, which was $500. So our debit is to AP Harriet Wholesalers for $500. The other thing we need to reduce is the amount of inventory that we have on our books. We don't have this anymore. We returned it to the vendor. So we reduce our merchandise inventory asset account by crediting it for $500. What happened here is we returned damaged inventory. On July 14th, Halo Hats is going to pay Harriet Wholesalers the full balance that we owe to them at the time. Well, let's look at our T account for AP Harriet Wholesalers. When we originally made the purchase, we put the payable on the books for $6,000. However, we're returning $500 worth of inventory to them we already have, which means we don't owe them the full $6,000 anymore. We owe them $5,500. So on July 14th, when we make this payment, the first thing we need to do is take that payable off the books by debiting it for the amount that is on our books for, which is $5,500. We purchased these baseball caps on July 1st. It is now July 14th, which means it is 13 days later. Well, the original terms that we had when we made this transaction was $215 net 30. We would get 2% off if we paid within 15 days. And since 13 days have passed, we are paying within 15 days, which means we get that 2% discount. The discount goes into merchandise inventory. Why? Because merchandise inventory, like I said before, is always carried at the cost you paid to acquire it. Well, we're getting a discount, which means the amount that we put it on the books for originally is more than we actually ended up paying. So we need to reduce the value of our merchandise inventory asset account by crediting it for the amount of the discount, which we find by taking the amount that we had on the books, the $5,500, and multiplying it by the discount percentage of 2%. We're getting $110 off, which means we're not sending them the full $5,500 in cash. Since we got 2% off, we're only sending them the other 98%. So if we take $5,500 and multiply it by 0.98, we come up with $5,390. That is the amount of cash we are sending to Harriet Wholesalers, and we are paying them within the discount period. Let's sell some inventory on account. On July 16th, Halo Hats is going to sell 400 baseball caps to a company called Hazmart. We're going to do so for $2,000. The customer is going to pay all the shipping costs, so we don't got to worry about that on our books. They got that covered. We are offering Hazmart credit terms of 310 net EOM, which stands for end of month. So they have to the end of July to pay us. Every time we make a sale, it's going to require us to record two entries. The first entry is going to record the revenues. So on July 16th, when we record these revenues, we're going to debit however we're being paid. This is on account, and since it's on account, we are going to put a receivable on. Just like we had a subsidiary account for the payable, let's have one for each company that owes us money. So instead of just accounts receivable, it's going to be accounts receivable dash Hasmart. We're abiding by this conservatism principle, which means we expect every customer we sell to pay within the discount period. We can't put this full receivable on the books at $2,000 because we don't expect them to send us $2,000. We expect them to send us that $2,000 less the 3% discount because we expect them to pay within 10 days. So if they do get that 3% discount, they're only going to send us 97% of the amount that we billed them for, which is $1,940. So we put Hasmart's receivable on the books at $1,940. What did we do here? We made a sale. That's how we generate revenue. So we're going to credit sales revenue for $1,940 as well. We sold inventory on account 310 net end of month. On July 16th, Halo Hats is going to sell 400 baseball caps to Hasmart for $2,000. Credit terms are 310 net end of month. COGS was $1,150. The second part is what's important because now we need to record the expense. The entry to record the expense on a sale is always exactly the same. It is a debit to your expense account, which is cost of goods sold, the primary expense account for any merchandiser. And you debit cost of goods sold for the cost that you originally paid to acquire that merchandise. In this case, that's that $1,150. Then you have to take the inventory that you actually sold off your books. So you're going to credit merchandise inventory for the same $1,150. And what we did here is we recorded COGS on sale. Customers will return inventory. It's just a fact of life when you're a merchandiser. If a company really wants to accurately depict its financial situation, what they should do is they should make an adjustment that separates the amount of inventory you actually have on hand and adds to it the amount of inventory that you expect to be returned from sales that you made during that period. You should also create a liability for the amount of refunds you expect to give to your customer. So the adjusting entry that you would do for this is a debit to estimated returns inventory and a credit to refunds payable. Companies make this periodically based on the historical percentage of inventory that's returned to them. If 1% of sales are returned historically to your company, well then at the end of each period you would make this entry equal to 1% of that month's sales revenue. Let's assume that Halo Hats has already made that entry before this happens. On July 19th, Hasmart is going to return 40 baseball caps to Halo Hats and they're going to get a $200 refund. Well, in this entry, we're going to have to record two transactions as well. The first one is going to reduce our receivable. So when we reduce the receivable on July 19th, we're going to take it out of that refunds payable, right? We are refunding right now, which means our liability for future refunds has to be going down. And like all liabilities, refunds payable is going to go down on the debit side. So we debit refunds payable for that $200 refund that we are giving to Hasmart. What else do we have to reduce? The amount of money that Hasmart owes us. If they're returning baseball caps to us, they're not going to pay it to us eventually. They're not going to pay for those caps. So we should reduce their receivable by the same $200. What happened here is we reduced Hasmart's receivable. The second entry is we need to put that inventory that's being returned to us back on the books. And then we put it back on the books, we're going to put it into merchandise inventory. So we debit merchandise inventory for the amount that's being returned to us, and we credit estimated returns inventory for that $200. We recorded this returned inventory. So now, let's say that we're receiving a payment from a customer, in this case Hasmart, within the discount period. On July 23rd, Hasmart is going to pay Halo Hats the remaining balance that is owed from that purchase they made from us on July 16th. Well, originally, We had $1,940 receivable on the books. We assumed they were going to get their discount, and that's how much they were going to send us. Well, we just gave them $200 off when they returned some of that inventory to us. So right now, the balance of the receivable from them is $1,740. So since that's the balance of the receivable, that's what they're going to pay us. So we are going to debit cash for $1,740. We sold this inventory on July 16th. We are receiving payment from Hazmart on July 23rd. That means 7 days have passed. And since the original terms were $310 net end of month, they are paying within a discount period. But we were conservative to start with. We assumed that they were going to get that discount. So the discount has already been factored in to this transaction on our books. And since that happened, that came to fruition, if you will, we don't have to do anything special. We can just take that receivable off the books because we've already accounted for the discount. So AR Hazmart gets credited for $1,740. And we receive payment from Hazmart within the discount period. Let's take another selling example. This time somebody's going to miss the discount eventually. On September 1st, ABC Company is going to sell 40 widgets to Dollar Sergeant for $4,000, and we're going to offer them credit terms of $510 net 60. They get 5% off. They pay within 10 days. The full net balance is due to us within 60 days. These $4,000 worth of widgets that we are selling to Dollar Sergeant, or I should say these widgets that we are charging Dollar Sergeant $4,000 for, originally cost us $1,900. So that is going to be our COGS, or our cost of goods sold. 2 entries always. Every time you have a sale, the first one is going to record the revenue, and that is on September 1st. We're going to record the revenue by first putting the receivable on the books. So we have AR from Dollar Sergeant. We are going to assume that they're going to pay within that 10-day discount period to get 5% off. And since they're going to get 5% off, they're eventually only going to pay us 95% of that full $4,000 balance. So when we put the receivable on the books, we're not going to put it on for the full $4,000. We're going to be conservative. We're going to put it on our books for $3,800. And we made a sale, so the credit in this entry is going to be a credit to sales revenue for that same $3,800. We sold some inventory on account. In the second entry, we need to record the expense. So on September 1st, when ABC Company sells this, we're going to record our COGS entry with the same COGS entry that happens every time you make a sale. It is a debit to cost of goods sold and a credit to merchandise inventory for whatever your cost basis is in that inventory you sold. For ABC Company, it was $1,900. Let's debit COGS for $1,900, credit merchandise inventory for $1,900. We recorded COGS on sale. Let's fast forward in time till September 23rd, when Dollar Sergeant is going to pay us for the widgets that they purchased on September 1st. Well, we're going to receive cash. And the amount of cash that we're going to receive is $4,000. Why is it $4,000? Because that's how much the full value was. Sure, we put the receivable on the books, net of discount, but they're not going to get the discount. Why? Because we sold it on September 1st. They paid us on September 23rd, so 22 days had passed. Well, our original terms were $510 net 60, so they had to pay within 10 days if they wanted to get that 5% discount. It's been way more than 10 days, so they're not getting any discount, so they're not going to send us that discounted amount that we assumed we were going to get. They're going to have to send us the full amount of the sale, which was $4,000, which is why we debit cash for $4,000. However, when we put that receivable on the books, we did assume they were going to get that discount, and we put the receivable on the books for $3,800. Well, we can't take the receivable off the books for $4,000 because there's only $3,800 of receivable on our books from Dollar Sergeant. If we did that, it would look like they owed us negative $200. And how does someone owe you negative money? It doesn't work that way. So what we need to do is we need to take the receivable off the books for as much as we possibly can, the full amount that we have right here, which is $3,800. And since our debits don't equal our credits, we're missing $200. We got to do something with that. And that's something that we're going to do is we're going to credit a separate revenue account called sales discount forfeited. And that is for the $200 that Dollar Sergeant is giving up by missing their discount period. We don't just put this into sales revenue. We're going to record it into a separate account. So purely our company knows, how much of our revenue is coming in from sales and how much was coming in from people missing the discount period. And that sales discount forfeited account is a separate revenue account. You have to report it as a separate line on an income statement. So you can't just merge it all together. You've got to tell people that there's a discount being forfeited here. Typically, though I have seen otherwise, this goes under the section of an income statement called Other Revenue and Expenses. I think that's good enough information to help you guys succeed with your quiz. Let me know if you have questions. Have a good one.